All right, welcome everybody. We have big earnings season, big earnings day today. We're going to cover an earnings report from last night, and then I think two that came out this morning. To do that, I asked a couple of my good friends who are also crazy about the market and in a lot of these companies, Jason Hall from The Smattering to join me, and John Quast from Working Capital JQ. How are you guys doing?
Hey, Travis. Good,
I'm
doing good, doing good.
I'm excited to be on it, John. It's been a long time since you and I did anything together, so I'm really
That's
excited
true.
about it right now.
Yeah.
Well, we're going to kick it off here with Microsoft. And I think this is one of the really interesting companies in tech right now. There's a lot of turmoil in technology, a lot of the SaaS businesses that have dropped 80, 90%. And then you have these giants like Microsoft who seem like they can do no wrong. And I was listening to the conference call last night, and I just couldn't get out of my head that this is a company that's so well positioned for the next 5 to 10 years. So let's dig into these numbers. I'm gonna lead the discussion here, and you guys can jump in with anything that you have to say. I'm gonna start here with the income statement. And on the surface, some of these items don't look great. Product revenue was down from almost $21 billion a year ago to $16 billion. But that was actually because of a decline in sales for some of their tablets and then also gaming devices. So I don't think that's a huge surprise. What is really impressive is the company's services and other revenue. So this includes Microsoft 365, all their cloud services like Azure, AI things that they're starting to do now. And I just momentum behind this entire business that it seems like it's just building. So even as companies are starting to pull back on maybe what they're spending on software as a service, this is actually a company that may be capturing customers. And management talked about this yesterday, because as a company goes and says, oh, man, we want to cut our software spend 20%. What are we going to do? Well, you make a list of all the software you have and you go, Microsoft has a calendar tool and a project management tool. Maybe it's not as good as this bespoke product that we've been paying for, but it's cheaper and it's included, and we have all the management systems behind it already in our IT infrastructure. So that's kind of the theme here that I'm looking at. Earnings were down a little bit from a year ago, 250 to $2.20 last quarter. The balance sheet, again, rock solid, $99.5 billion in cash and equivalents. And then when we go down here to liability, again, they've got some debt, but they've been paying that down a little bit. So nothing really to be worried about from an income statement. And then the statement of cash flow. So this tells us where all this cash is going. Microsoft is on kind of a 6-month lag from the calendar year. So this is the first 6 months of their fiscal year. Cash generated in the first part of the year was $34 billion. And they used a huge chunk of that to buy back stock and pay dividends. So this is definitely a company that's growing, at least in its core services, but it's also returning a ton of cash to shareholders, which I always like to see. There are 3 business segments that we can break Microsoft down into: productivity and business processes. This is where things are really growing. This is like the Microsoft 365 suite of products. So maybe not an exciting business, but very critical business. I think of this as the kind of product that if this went down, the entire world's business infrastructure would go down. I may be overstating it a little bit there, but I think, it is very critical business tools. So revenue up 14%, just kind of steady as you go. Look at the commercial seat growth of 16% for Office 365. Microsoft 365 customers up to, I'm on the wrong side here, up to 63.2 million people. 12% growth is what it was in the quarter. So really solid numbers there. What's more exciting for investors is this cloud segment, the intelligent cloud, as they're talking about it. This includes a bunch of businesses, so it isn't quite comparable to Amazon's AWS, but that's probably the best the best comparison. So again, year over year revenue up 20%, 26% on a constant currency basis. Just steady as you go. And we can talk about some of the detailed numbers in here, but Microsoft Azure is growing. I think the number was 31% in the quarter. And then here was the negative in the results: personal computing. So this is the primarily hardware products that Microsoft is making, has been down over the last, actually sequentially, just slightly. But this is going to be a weak segment in the market as we come out of the pandemic. People are buying fewer computers, fewer gaming devices. That's just generally going to be a little bit of a drag for Microsoft. I think the way to think about this company, and when I think about them strategically, is they've really gotten out of the business of being tied to hardware in the way that they were for the first 30 years of their history. They had the Wintel kind of behemoth in PCs, where they made the operating system and a lot of the productivity tools. Intel made the chips, and then there was a whole bunch of other commodity players selling devices and manufacturing computers. They really moved to a more cloud-based software model where they don't care if you're accessing Microsoft 365 on a Mac, on an iPhone, on a PC, what kind of device you're on, as long as you're using their services. Same thing with Teams. And I think that's going to be really interesting as they grow into the cloud, because they're now not only providing services in the cloud, into artificial intelligence, because they're not only providing artificial intelligence tools within some of these software suites, but they're going to be the cloud service provider. Excuse me. They're going to be the cloud service provider for OpenAI specifically, and I think potentially other AI companies, given the back end that they're building. And so now you're going to have other companies building on top of this AI focused cloud. So that's probably the next leg of growth for them. And I see so much momentum behind the business now, and I just don't see it stopping with some of these macro trends. I'll start with you, John. Anything you wanted to add here as you kind of look through the numbers and think about where Microsoft is sitting today?
To your point, it's a very good thing that they have moved away from just being an exclusive hardware business, because, well, not exclusive hardware business, but being so tied to the hardware side of things, because I can't imagine what this business would be worth without all of its software services and cloud offerings. And I can't imagine how much the stock would be down today if it was primarily hardware, because as you look, Windows devices sales down 39% year over year. You look at Xbox hardware down 13% year over year. It's not surprising. You see this in other PC companies. The demand is way down right now in personal computers, and Xbox didn't have an update recently. So you would expect that kind of thing. But yeah, cloud really coming in here as the big hero. One of the things I'll point out here is remaining performance obligations. So a lot of this is tied to Microsoft Azure. So coming in right now,
future revenue tied to long-term contracts when it delivers the services, right?
Absolutely. Yeah. Thanks, Jason. Where is it? I had it right here. There it is. Remaining performance obligations, 189 billion, up 29% year over year. Here's what's interesting about this to me. You look at what is expected to be recognized in the next 12 months, 45% of that. Yeah. The rest of it beyond 12 months, and that portion of the RPO was up 32% year over year. So the stuff that is being put under contract beyond 12 months is actually growing faster than the stuff that is right now. So as you think about that, that really points to companies saying, yeah, we still are going to spend here with Azure, maybe pushing some of those obligations out a little bit further. I think it's going to be a trend generally that we see with enterprise software in the coming year.
Jason, do you have thoughts?
Yeah, just a couple things to add. I think in general, like my view of Microsoft is that the business in aggregate has always been higher quality than the individual products. And you talked about that a little bit, right? The bundles that create so much value and make it so sticky and hard for companies to leave Microsoft. And make them more likely to come to Microsoft for other things, is really, really powerful. So I think investors, if you're looking at other companies that have competing products that are maybe better, that doesn't necessarily mean they're going to win when they're competing against Microsoft. That's important. Thinking about the balance sheet, cash flows, again, they're down, but they're still incredibly strong. Feeding that into that massive cash that's on the balance sheet. Travis, I think the odds are still probably better than even they have to buy Activision Blizzard. We'll see if that deal completely comes apart or not. But that's
I would
a
love it if
ton
they
of cash.
didn't, though.
What's that?
I would love it if they didn't, to be fair.
Oh, and I honestly, I kind of wonder if maybe management would also not love it if it didn't happen at that valuation. But the point is that if it does happen, and they have to vigorously fight it, they really do have an obligation to. If that happens, that's a big chunk of cash that's going to come off the balance sheet. That it's really curious what kind of returns that investment is going to generate from creating that, adding to its gaming business. So I think investors need to think about that return, because let's be honest, Microsoft has made some good acquisitions over the years. It's also made some really terrible acquisitions and overpaid. And there's a chance this is going to be another one of those. Investors need to think about that going forward. I think those are the main things I wanted to say. And the last one, you mentioned share buybacks. And I took a look at like a long-term chart. And here's the reality. I'm going to, let me do a quick screen share. So I'm going to share us, and then I'm going to flip over. Do you see the Microsoft chart now, guys?
Yep.
This is share buybacks over the past 10 years. This is over the past 3 years and over the past year. Microsoft is not, the company's become on a market cap basis so gigantic. At this point, it's those share buybacks are, they're material, but they're not meaningful. I think just remember that, because a lot of them are still covering stock-based compensation, and it's a modest decrease in the actual share count in total.
Yeah, I want to point out two things. I haven't updated this, but according to Google Finance right now, the price to earnings multiple is 26 and the dividend yield is 1.2%. So from a value perspective, maybe a little bit questionable. I think this is the kind of company where if you just hold it for the next 10 or 20 years, you're probably going to do pretty well. But do you want to get it at a lower price? Yeah, maybe. The other thing is, just to give my backstory with Microsoft, this is a company that I bought maybe almost 10 years ago now, on the thesis that, oh my gosh, this stock was so cheap. I think,
man, you timed it perfectly, dude. That's
well, hold on. Now, I think it was trading for like 9 times earnings or something like that, and had a ton of cash on the balance sheet. But you could see the business was kind of in decline because they were still tied to the PC at that time.
It was in limbo. Exactly. The business today didn't exist.
Right. I made a very good return, maybe 50%, maybe 100%. And then I sold it. And I think this is another good example, a good lesson for those of you watching, of letting a business buy in at an attractive price, and then let management, if they're good at what they do what they do over time. Microsoft has grown steadily, but if you look at their long-term chart, this isn't a company that grows, at an Amazon rate from a revenue growth perspective, but they've grown a little bit from both the top and the bottom line from that period of time, and they've got a higher multiple. So that as a result, the stock has done extremely well. And if I had just held on, which I didn't, I would have had a really great investment riding the back of these strategic changes that have taken a little while to really take hold. And now the challenge for somebody like me looking at this stock is, do I want to pay a 26 price to earnings multiple for a $1.8 trillion company? How are they going to make that a value long term? I think that's a much harder task than when Satya Nadella took over, and he can make some strategic changes, optimize the business a little bit, grow, and then also ride the wave of that expanding multiple. So just kind of something to think about from a context perspective. I think right now there are a lot of investments where you can look at it and go, wow, this is really cheap, and I could justify, if I'm wrong, that's okay, because I'm going to buy a basket of 5 or 10 of these really cheap companies, and one of them is going to be the next 10x kind of a stack. So
Yeah,
any
I like
final
that you
thoughts here?
mentioned that. That was going to be my point. I see a much stronger case to hold Microsoft than to buy Microsoft today because of that.
Yeah, I think that's a good point. Jason, you want to bring us into ASML?
Yeah, so ASML, the Dutch company that I've heard people describe their technology. It's not rocket science; it's harder. It's incredible what they do, and I think this is easily one of the 3 most important companies in the world in the semiconductor industry,
Can
if
you
not
just
the
go
most
over
important.
exactly what they do and how they fit?
Yeah, so their lithography technology, which is essentially the way that it's the machine that creates the image that is then printed on the
chip.
wafers to make the semiconductors. And they operate in this extremely high ultraviolet frequencies to do this lithography to make the image small enough. They're decades ahead of anybody else. They're absolute decades ahead of anybody else. Essentially, every single top tier, highest performance chip that's manufactured in the world is made using their equipment. They're that important, right? So that's the key. I mean, this is a company that sells, and you'll see the numbers in a little bit. They sell around 300 machines a year, and you'll see the numbers that they generate. And a company that sells 300 of something a year and is this important is incredibly rare. So again, it's a Dutch company, so they report in euros. We'll get into what some of these numbers mean in just a minute. But a couple things I want to call out. And again, this is the quarterly numbers here out of their slides from their presentation. Here's the full year results. Again, this is an equipment manufacturer that's getting 50% gross margins. They continue to pile a ton of their money. So again, $21 billion in revenue for the year, and they spent 15% of that on R&D. So they're not sitting back on their technology and saying, okay, let's just let the money run in. They continue to invest in maintaining and building on that lead. So a couple of key things. Again, while a lot of this in 2022 was a pretty good year for the semiconductor industry, right? So we're looking at sales for last year, and we've gone into a bit of a slowdown, which we know, and we're hearing a little bit about that. And we're seeing it in some of the companies that actually make the semiconductors or the fabless companies that design them. But basically, the companies that are selling the semiconductors to somebody, their numbers are not as good as what we saw from ASML to finish the year. 14% revenue growth. That's wonderful revenue growth. The key is the EUV extreme UV machines. Revenue was up 12%. In the quarter, they sold, or in the year, they sold 40 that they recognized revenue for, and they shipped a total of 54. So there's 14 that they shipped that haven't fully installed that they'll recognize revenue for in the first quarter of this year. And you see the orders continue to come in from its big customers that use those EUV machines. So that's Taiwan Semi, Samsung, and a few others. The key is that it's really, really growing. Their machines are not just used for logic chips, but they're also used for memory a lot. They're really dominant and have a substantial amount of market share there. Their install base grew 16%. The company's pretty mature, even though the long tail is very strong growth over the next decade. But they're really focused, because it is a mature business. They're focused on share buybacks and increasing their dividend. I think they increased their dividend about 5%, bought back a decent amount of shares. Here's their outlook. Expecting another good quarter and accelerating sales growth as the year goes on. Again, they're still expecting really good gross margin. Going to continue to spend money on R&D. Maybe not as much as we saw last year. They go through phases where they spend significant amounts. But again, it's still going to be probably that 12 to 15% of revenue. But again, looking at as sales go throughout the year, looking at 25% growth. So almost double the sales rate that we saw this year. And this is important to understand the nature of their business. Again, ASML is a supplier to the semiconductor industry. So as the semiconductor companies, they're dealing with what Microsoft was talking about with their hardware sales decline. The PC business is kind of slowing. Those are things that are affecting the Taiwan Semis and the Intels and the Samsungs of the world. But what those companies are also looking at is that the expectation that by, I think, 2029 is the expectation that the semiconductor industry is going to generate about $1 trillion a year in sales. It's still at a very, very rapid growth rate. And you're going to see companies like Taiwan Semi, I keep mentioning that one, that's probably ASML's most important customer by a long shot, is going to spend $300 or $400 billion over an 8 or 10 year period. And a lot of that money is going to go to ASML for their machines. So while those companies are experiencing a slowdown, they can't not invest in having the next best models of these machines to be able to make the next chips that NVIDIA designs, that Apple designs, because that's their customers, right? They have to be ready when those companies are ready, and maintain the lead that they've built in their businesses. So that's really important. I want to hop over to, and guys, I need you to tell me for sure if you can see this. Do you see this slide from their presentation?
Yes,
You got it.
The bottom line here. Okay. So again, this is the lithography systems, 2018, less than 250, last year over 345. And then you look at these bookings, right? These revenue bookings numbers, they have just an incredible backlog in their business that continues to grow. And while their business will be cyclical over time, I think it's less cyclical than we see it on the end user serving side, the companies that are making the semiconductors. We probably have a good 4 or 5 year run, at least, I think, before maybe things start to slow down for ASML.
How do you think about value with a company like this? I'm looking at their info right now. It looks like $270 billion market cap.
Right. It's tough, right? I'll be honest. I don't own any ASML. That's going to change soon because I've really biased myself because it's tends to trade at a very rich valuation, but deservedly so. I think that's the key because it has built so many strong economic moats, and it continues to build those. It's there, like with any technology, there's always the risk of some disruption that kind of comes out of nowhere.
The way that they did to a company like Intel.
Yeah, I think that's fair. And for ASML, it could be something with quantum computing, right? Where just the way computing is done changes at a fundamental level, right? So I think maybe that's the future disruption. But the need for kind of this semiconductor-based ones and zeros computing, even when we get to a world of quantum computing, I don't think goes away, right? So I think ASML is one of those companies that it's probably always going to look very expensive. But again, like Microsoft, you look at again, this is a manufacturer like that's in the middle, right? They're not even serving the end customer, and they generate on equipment over 50% gross margins, generate incredible cash returns. It's a business that I think having some exposure to makes sense. And the stock is down. It's come back some, but it's still down double digits from its highs. And not anchoring on those highs, but looking forward, because this is also a really good services-based business as well. It's just not the hardware they sell. They service the machines. They operate the machines in some cases. They have some really, really strong advantages that to continue generating really high revenue, high margin revenue for the long term. And I think it's worth owning at this price.
Jason, I agree with you on the probably always going to look like a non-value stock. Just looking at management's long-term bull case, they're saying up to 60 billion euros annual revenue by 2030.
Right.
If you look at the market valuation right now, it's trading at about 4 times that 2030 revenue number. So yeah, I would say that that's extremely pricey. At the same time, I look at Chipotle Mexican Grill as a comparison here. Has there ever been a good time to get into Chipotle Mexican Grill from a fundamental value opportunity? No, it's because it's the best run business probably that you can invest in, period. There's only been brief times where it came down, the E. coli breakout, the beginning of the pandemic crash, but it was still not trading at a below average valuation to the market. It was never trading at a discount. So it was a company that you had to just kind of suck it up and invest in it, and you've made great returns because the business is that valuable. I think ASML probably somewhere in there. I'm not saying that every price is always going to make sense, but it's probably one of those companies always going to look overvalued. Go ahead and buy some, get exposure, and then if it comes down in valuation to something more attractive, add.
And there's one other thing I want to add to that too. Our friend and colleague Jose Najarro and I did a video recently. We were talking about ASML, and I applied David Gardner's snap test. Snap your fingers and the business goes away. And when I did that with Jose, he said he actually kind of got a little scared at the thought of ASML going away.
Yeah.
And let's be honest, everything you said about Chipotle is right. But if you snap your fingers, there's other decent burritos people can find out there. If you snap your fingers and ASML goes away, nobody can make the most important semiconductors in the world.
Yeah.
Period. Right. And that's
we move back probably 3 to 5 years from a chip standpoint.
Absolutely.
Well, and I want to add in a couple of just kind of strategic pieces. China has been trying to do what ASML does and make their own equipment. U.S. sanctions have basically meant that at least the leading edge equipment is not going to be able to be installed in China.
Yeah, that's like 15% of ASML's business last year too.
Yeah. Now, I think that they're probably going to be able to operate some of their legacy equipment. So that's going to continue to exist, but new plants are going to not be built in China. As a result, that kind of takes a potential competitor out of the market. I mean, I think that China would love to do what ASML does, but like you said, it's not rocket science, it's harder. So they have not proven the ability to be able to make the equipment and make chips in the same way that a company like Taiwan Semiconductor is. The other thing that I wanted to add is it's as I learn more about this industry, I keep that the basket is probably the right kind of approach, because maybe you are paying too much for ASML, but maybe Taiwan Semiconductor is cheap right now. And maybe the value kind of ebbs and flows between those two, but over time, and add a few other players in there, but over time, this is a growing industry. I think margins are going to continue to be really strong. There are going to be it is a cyclical business, so there is to it, but there is more and more recurring revenue from ASML too, because as I hear about how these plants are run in Taiwan, I mean, if the ASML employees, even as smart as the Taiwan Semiconductor employees are, they're not going to be able to necessarily run the equipment. So such a specialized field. Anything else you guys want to add before we move on?
Nope. Let's go. AT&T is next, right?
AT&T is next. We talked a little bit about, Jason and I talked about Verizon yesterday. A lot of sort of similar information from AT&T. I'll just go numbers. Net adds 2.9 million during the year. I just moved the quarterly number, but a pretty solid quarter as far as net adds go. And part of that is to their fiber business. I do think it's interesting to think about the strategy difference that Verizon has and AT&T has right now. Verizon is really leaning into what they call their fixed wireless, meaning 5G wireless, and AT&T is leaning into fiber. So kind of two different strategies, at least adjacent to each other. You can see revenue growth was not great from a year ago, especially when you look at the subscriber addition. So that's partially because they're not selling as much hardware, which is something we also saw with Verizon. But they did have really strong cash flow from operations. So that's a positive for the business. They have two segments here. We'll cover mobility first, incrementally a little bit better than a year ago, $21.5 billion in EBITDA. Margins ticked up a little bit higher as well. Postpaid phones, that's another thing that's going to be kind of ebb and flow, but 656,000 additions there. So that's pretty solid, and they've been adding over time, which is again something that Verizon has been much more choppy at. Here's their wireline business. So consumer wireline, and then the business wireline is actually where they make a majority segment. So again, not gonna knock your socks off, but just kind of a steady as you go business. The one thing that I think is always interesting to think about with AT&T, I would argue that it's maybe a better operator than Verizon, but then you get items like this. Loss during the quarter, and a huge part of it is goodwill impairment of $24.8 billion associated with business wireline, consumer wireline, and Mexico reporting units. So
So
they
just
always,
when every investor out there was saying, "Hey, well, all the bad stuff's done. They've spun off the
yep.
entertainment business. Whew, we can move on here." And then this, right?
Yeah, and that's what I keep going back to is they get the big things from the operating standpoint, and then they mess up some sort of huge position or merger that they just doesn't need to happen. They do have their Mexico results in here. Mexico is growing, but it's losing money. If you're AT&T, why are you in Mexico? Just don't be there. So
Yeah.
Verizon has done things like buy Yahoo, but those were really small numbers. Time Warner and DirecTV. And those kind of deals are just destroying shareholder value. So it's like you have this cash cow business and then you just light the money on fire on the other end. That's what I think is kind of drives me nuts, because I would love to say, hey, buy AT&T, buy Verizon, maybe even buy T-Mobile and just have a basket. Telecommunications isn't going anywhere. Wireless isn't going anywhere. It's going to be a really profitable business. But every time I look at AT&T, I go, gosh, what are they going to do next? What are they going to do to mess up the balance sheet and incur some sort of multi-billion-dollar loss next? But what did you guys think when you were looking at these results? Jason, you want to start?
Yeah, no, I think it's one of those things that you really, hopefully, this is just kind of a product of some legacy challenges within the business, and that we have the CEO that's been in place has been there. Is it a year now? I guess it's probably close to a year. Um, Leading the company forward, right? And to really kind of be back to basics and focus on that core telecom business, driving the things that are really going to affect its business: fiber, the wireless business, 5G that it can use, because 5G is really an opportunity. As much as I talked about with Verizon, that it's like you have to do it. If you're AT&T, you have to spend this tens of billions of dollars every year for 4 or 5 years to scale it up, just to maintain your existing customers, wireless customers.
Yep.
But it's also such a sea change because it can handle so much more data that you kind of have optionality, right? If you're a data user, you're in a remote location, you don't have access to fast internet. 5G all of a sudden can change that. If you're a business and in your operation, you have machines that need to be connected. There's
Cars are
opportunity,
now coming with
right?
5G. Yeah.
Yeah, there's so much opportunity to grow, right? To just literally grow the business in terms of that data business with 5G, that I think that's really important they continue to focus on that more than anything else. I hope that the past lessons, the current management has going to continue to learn from those and allocate capital better. The balance sheet is stronger, right? But this is a company that still has $136 billion in total debt. But it has a lot less cash than it did pre-split as well. So it runs leaner from a cash perspective. So it really relies on turning that cash and living within its working capital more than it did prior. So that means the margin of error, the margin of safety is narrower to execute well. I think that's really important for investors to consider, particularly as interest rates and that cost of capital continue to move higher. It's not going to have the same ability to make those giant mistakes and them not be, they're going to be more costly if it makes those big mistakes going forward, because it runs leaner within its working capital, and it still has a tremendous amount of debt that it has to service.
Yeah, $136 billion in debt is the number, and the cash on the balance sheet right now is $3.7 billion. So that's pretty tight, like you were saying. Again, like for Verizon, I would argue that AT&T is another company that the right way to allocate capital might be to say, hey, we're going to stop paying the dividend for a year or 2 or 3 and start paying down debt. Investors don't like that. So that's not going to happen.
Well, they've already cut the dividend once, right? Can you do it again?
Yeah. So this is always a conundrum that some of these companies get themselves into. You gotta just keep the dividend going, raise it slowly but surely over time. But I would really like to see them pay down debt to give them a little more flexibility. John, what are your thoughts here?
I don't really follow the cell phone industry, these carrier providers. So I'm listening and I'm thinking about this from a very high level. I'm listening to what Jason is saying about growth opportunities for AT&T and whatnot. But as you look at these businesses from a what is their business comprised of right now, those aren't really growth industries. We're at a very high level of consumer adoption already. And so there's great cash flow, right? And it's very tempting from a investment perspective to look at a 6%, 7% dividend and say this is a fantastically cheap stock. However, a business at this stage of its life cycle, they really have to nail that capital allocation because they're not creating much shareholder value from the growth opportunities. The shareholder value creation is happening from how they're using that capital. And if they are making those mistakes with buying businesses that don't make any sense and investing in things that don't make any sense, this isn't really a market beating opportunity. They have to get that right, in my opinion. So that would be my biggest concern is I'm looking at AT&T, seeing that impairment charge once again show up. It's always rearing its ugly head, as you point out, Travis. But I'm also hearing what Jason is saying. There are opportunities there. Does it have the track record at this point to put your faith in this team that they're going to be able to make those better decisions going forward? I don't know.
Yeah, I'll just give the final words here. I own shares of Verizon. I have looked at shares of AT&T. Like we talked about with Microsoft, I like the potential of buying cheap with the opportunity to maybe grow into some of these things. The data usage and mobility, autonomous driving, virtual reality, cloud. There's all kinds of things that we can start using 5G for. And I think we're only starting to scratch the surface of that. But they've got to do it. And I think that's where we are right now is, are we seeing momentum in some of these potential growth segments? I like Verizon growing in fixed wireless, basically replacing cable with a router that's plugged into your wall and going 5G, peeling off customers from cable companies. I would like to see AT&T doing the same kinds of things. I would like to see both of these figure out ways to add value to some of these ancillary businesses that we don't hear a lot about. I'm sure they're working with them. Maybe as autonomy becomes a bigger thing, this will be a bigger draw of data. But I think a little bit more optimistic than you guys, but I totally understand the concerns about capital investment and things like that. All right. Well, we will be back here on YouTube and Twitter live as much as we can during earnings season. Don't forget to follow John at Working Capital JQ and Jason at The Smattering on YouTube and, of course, on Twitter as well. You can find me at Ravinvest. Thanks, everybody, for watching, and we'll see you all here next time.